Stop scrolling. Seriously, put down your coffee. Cancel your next meeting. Because while you were arguing about politics on Twitter and deciding which Netflix show to binge, the global financial system just had a stroke. And no, I'm not being dramatic. Well, maybe a little, but also not really. On January 20th, 2026, silver hit $95.87 per ounce. That's not a typo. $95 for silver. The metal your grandmother keeps in a drawer wrapped in felt, the poor man's gold. The thing Wall Street bets tried to squeeze 3 years ago and everyone laughed at them. Yeah, that's silver. It just went parabolic. And if you think this is just another commodity rally, congratulations, you've completely missed the point. This isn't about price. This is about the collapse of a 40-year pricing mechanism. This is about paper markets decoupling from physical reality. This is about the moment when investors worldwide simultaneously realized that the number on their screen has absolutely nothing to do with what you actually pay to hold the metal in your hand. And here's the really fun part. In Japan, physical silver is trading at $130 per ounce, not $95, $130. In Dubai, it's $100 to $110 depending on the dealer and whether they even have inventory. In Shanghai, premiums are running 12% to 13% above Western prices, which means the Chinese are paying $107 when Comex says $95. So which price is real? The one on your Bloomberg terminal, or the one the guy in Tokyo is actually paying to walk out of a shop with a bar of metal? If you answered both, you're technically correct, which is the worst kind of correct because it means the market is broken. When the same asset trades at two completely different prices in two different locations, and those prices stay divergent not for minutes, but for weeks, that's not arbitrage opportunity. That's market failure. That's a system announcing to the world, we have no idea what this thing is worth anymore, so everyone just make up your own number. And the absolutely hilarious part, in a dark comedy sort of way, is that this was completely predictable. We've been writing about silver shortages for 18 months. The deficit has been documented for 5 consecutive years. The Comex registered inventory has been dropping like a stone. China announced export restrictions on January 1st. Every single warning sign was flashing red. And yet, here we are, with financial media acting shocked that a commodity experiencing record industrial demand and collapsing supply might, I don't know, go up in price. So let me walk you through exactly what happened. Not the sanitized version your financial advisor will tell you. Not the markets are efficient fairy tale they teach in business school. The actual documented, this really happened version. Because if you don't understand what just occurred, you're going to miss what happens next. And trust me, what happens next is going to make $95 silver look quaint. Let's start with the number everyone is talking about. January 20th, 2026. Silver hits an intraday peak of $95.87 per ounce according to data from multiple sources including Trading Economics, AppMex, and Investing News. This shatters the previous all-time high of $49.45 set in January 1980 during the Hunt Brothers episode. For those keeping score at home, that's a 94% gain in 46 years. Except it's not really 46 years of gains. It's a 200% surge in basically 12 months because silver opened 2025 at around $29 per ounce according to Gold Silver. So in one calendar year, silver tripled, not doubled, tripled. And on January 21st, according to current data, silver is holding above $94, with Trading Economics reporting $94.99, JM Bullion showing $94.87, and Fortune documenting $95.32 at market open. These aren't flash crashes that recover. These aren't algorithmic glitches. These are sustained prices at levels that most analysts said were impossible without hyperinflation. Now here's where it gets interesting. While Western exchanges are quoting $95, physical dealers in Asia are operating in a completely different universe. According to Pareto Investors Analysis published in early January on January 1st, 2026, when Comex futures showed $72 per ounce, physical bullion dealers in Japan and the UAE were selling silver at $130 per ounce when they could find inventory. That's an 80% premium. Let me say that again slower for the people in the back. 80% premium for physical delivery over paper price. According to the same report, in Shanghai throughout late December, physical silver premiums exceeded $8 per ounce above Comex prices. Chinese buyers were offering foreign suppliers $8 premiums to secure metal. Indian buyers were offering $5 premiums. And across Asia, according to eyewitness reports, queues formed outside bullion dealers as physical inventory simply vanished from the market. People were lining up in 2026 to buy silver bars, like it's toilet paper during COVID, except toilet paper you can make more of, silver, not so much. Bullion Star, a major physical dealer, reported in their January 2026 market update that physical silver pricing on the Shanghai Gold Exchange has decisively broken away from Western paper benchmarks, with premiums reaching approximately 12% to 13% above LBMA spot and Comex futures prices. They describe this as exceptionally high by historical standards, and among the most extreme divergences observed in the modern silver market. In Japan, premiums on secondary market platforms like Mercari have surged to around 60% according to their data. In the UAE, particularly Dubai, premiums are running around 40%. So when I say the market is broken, I'm not editorializing. I'm describing documented reality. The paper price and the physical price have decoupled. And when pricing mechanisms decouple, one of two things is happening. Either the paper price is fake because there's not enough metal backing those contracts, or the physical premium is irrational panic buying. Given that this divergence has persisted for weeks and is getting worse, not better, I'm going with option one. Now let's talk about why this happened, because the why is more important than the what. There are three documented structural forces, and all three converged in January 2026, like a perfect storm designed by someone who really hates the Comex. Force number one, the physical squeeze. According to Trading Key's analysis published January 19th, between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn from Comex for delivery. That represented approximately 26% of Comex's registered inventory disappearing in a single week. Not rolled forward, not cash settled, actually delivered. Bars physically removed from the vault. According to multiple sources documenting the January delivery data, JP Morgan and Citigroup were aggressively taking delivery. Over 1,000 contracts went to actual delivery in a single day, with thousands more month to date. Pareto Investor notes, this is the same JP Morgan that paid a record $920 million fine in 2020 for manipulating precious metals futures markets. The irony is so thick you could plate silverware with it. Now, normally less than 5% of futures contracts result in physical delivery. Most are cash settled or rolled forward because traders don't actually want the metal, they want exposure to price movement. But in January 2026, delivery demands spiked to levels the exchange hasn't seen in decades. And here's the problem. According to Comex warehouse reports, registered silver inventory available for immediate delivery was approximately 45 million ounces entering January. If 33.45 million ounces got pulled in 1 week, that leaves about 11 to 12 million ounces for an entire global exchange. That's like a grocery store having 3 cans of soup left during a snowstorm and wondering why prices are going up. Force number 2. China's export ban. On January 1st, 2026, China implemented what multiple sources describe as the most aggressive precious metals export controls since rare earth restrictions. According to Pareto Investors reporting, only 44 companies received authorization to export silver over 2026-2027, establishing government gatekeepers over approximately 121 million ounces of annual exports, representing 60% to 70% of refined silver traded globally. According to Trading Key's analysis, China is effectively saying the rest of the world can no longer rely on Chinese refined silver to plug its deficits. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons, according to Pareto's data. They're a net exporter cutting off supply to the West, while their domestic buyers panic buy physical metal at any price. And just to make this even more entertaining, Elon Musk publicly commented on the restrictions. According to Pareto Investor, Musk posted on X on December 27, 2025, highlighting concerns over silver supply constraints and noting its essential role in industrial processes, particularly relevant for green technologies, EVs, electronics, and solar applications. When the richest man on Earth, who manufactures electric vehicles and solar panels, is publicly worrying about silver supply, that's not speculation. That's a supply chain crisis. Force number 3, the run on paper silver. For decades, according to Trading Key, global silver price discovery was controlled by futures traders on the New York Comex and the London Bullion Market Association. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At one point, the notional ratio reached as high as 356 to 1. In other words, for every 1 ounce of actual silver that existed in vaults, there were 356 ounces of paper claims on silver being traded. This system worked on one simple assumption. Nobody would ask for delivery all at once. In January 2026, that assumption failed. According to a Seeking Alpha analysis published January 1st, titled Comex Liquidation, the CME's margin hike is described as a textbook paper smash, a deliberate weaponization of margin requirements designed to save deeply short bullion banks from the impending physical shortage. The article describes spot prices getting hammered nearly 15% in 1 week to below $72 in intraday trading. right before the China export ban took effect. But here's what's fascinating. That price smash didn't hold. Within 2 weeks, silver was back above $90, then $95. Because you can manipulate paper prices all you want with margin requirements, but you can't print physical silver bars. According to a Chronicle Journal analysis published January the 2nd, registered silver inventories in Western vaults have plummeted by over 70% since 2020, based on LBMA and CME group data. Throughout 2025, industrial demand from AI hardware and renewable energy infrastructure consumed an estimated 60% of total global production. By late December, the Comex faced delivery demand of nearly 65 million ounces, a volume that the exchange reportedly struggled to fulfill, leading to rumors of cash-only settlements. When an exchange that is supposed to be the global price-setting mechanism for a commodity starts rumors about not being able to deliver that commodity, that's not a rumor, that's a confession. Now let's talk about what's driving the demand side, because it's not just investors buying silver coins to bury in their backyard, although that's definitely happening. The industrial demand story is real and documented. According to the Silver Institute's data cited by multiple sources, 2025 marked the 5th consecutive year where global demand significantly outstripped mine production and recycling combined. Financial content? January 20th analysis states that deficits in 2023 and 2024 were roughly 140 to 200 million ounces, and preliminary estimates for 2026 suggest the gap has widened further. Bullion Star's report notes that industrial applications consumed over 25% of annual global supply in 2025, with solar panel manufacturing alone driving unprecedented demand. Solar panels are the monster in the room. According to Gold Silver's market analysis, solar consumption hit a new all-time high in 2025 and is expected to nearly double silver demand between 2020 and 2030. By 2050, cumulative solar demand could equal 85% to 98% of today's known silver reserves. Think about that. In 24 years, solar panels alone could consume essentially all the silver we know exists underground. That's not a bull case. That's physics plus policy. Every government on Earth wants more solar. Solar needs silver. Silver is finite. The math doesn't work. Electric vehicles are the other major driver. According to Gold Silver, EV-related silver demand jumped an estimated 20% in 2025, driven by the growing use of sensors, high-voltage wiring, and control systems. Each EV contains about 25 to 50 grams of silver, depending on the model. Doesn't sound like much until you multiply by tens of millions of vehicles per year. And AI data centers? Also silver-intensive for thermal management and high-performance wiring. The technological revolution requires conductive metals. There are only 2 highly conductive metals that are economically viable at scale: copper and silver. Copper can't do everything silver does. Therefore, silver is not optional. Now, what about supply? Because if demand is skyrocketing, surely the mining industry is ramping up production to meet it, right? Well, according to Financial Content's January 20th analysis of the industrial supply crisis, the answer is a hard no. The current price explosion is described as the culmination of a 5-year structural supply deficit that the mining industry has struggled to address. New mine development takes 7 to 10 years from discovery to production. The price signal from 2025 won't result in new supply until 2032 at the earliest. And even then, most silver is produced as a byproduct of copper, lead, and zinc mining. You can't just make more silver without having copper or lead deposits that need mining. So we have inelastic supply, soaring industrial demand, 5 consecutive years of deficits, China cutting off exports, and a paper market that just discovered it doesn't have enough physical backing. What could possibly go wrong? According to Bank of America's Michael Widmer, quoted in a Be in Crypto article from January 20th, silver could rise to between $135 and $309 per ounce in 2026. Not $50, not $75, between $135 and $309 from one of the largest investment banks in the world. That's not some gold pug conspiracy theorist blog. That's Bank of America. And analysts aren't alone in these projections. According to multiple sources, mainstream analysts now consider $100 per ounce a valid near-term target. APMEX's silver price page notes, a year ago, it would have seemed very unlikely that silver would pass $100 in this time frame. Most analysts are predicting that silver will cross over $100 in 2026, given its current scarcity exacerbated by geopolitical policies. One analyst cited by Gold Silver suggests silver's technical pattern points to a measured target of $400 per ounce based on a multi-decade cup and handle formation. $400 for silver. The same metal that was $14 in 2015. I know that sounds insane, but consider this. The 1980 high of $49.45 adjusts to $194 in 2025 according to APMEX. So silver reaching $200 wouldn't even match its inflation-adjusted peak from 46 years ago. It would just be catching up to where it's already been in real terms. And here's something else to consider: the gold to silver ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has ranged from 15:1 to 60.1. In 2020, it spiked to 120.1, meaning silver was extremely undervalued relative to gold. As of January 2026, according to APMEX, the ratio is around 50.1. If gold is $4,700 and the ratio goes to 30.1, silver is $156. If the ratio compresses to the historical low of 15:1, silver is $313. So Bank of America's $309 target isn't pulled from thin air. It's predicated on a return to historical norms in the gold-silver ratio combined with continued gold strength. Now let's address the elephant in the room: the conspiracy theories. Because the silver market has more conspiracy theories than Area 51, and some of them are actually true, which makes sorting fact from fiction extremely difficult. According to Pareto Investor, the same JP Morgan that is now aggressively taking delivery is the same JP Morgan that paid $920 million in 2020 for spoofing silver markets from 2008 to 2016. According to Bullion Trading LLC's analysis, JP Morgan's stock closed at $334.61 on January 6, 2026, near its 52-week high, with trailing 12-month net income of $66 billion and total assets exceeding $4 trillion. So no, JP Morgan is not collapsing from silver shorts. That's not happening. But the narrative that major banks manipulated silver prices for years? That's not conspiracy theory. That's documented federal crime with convictions and prison sentences. What's happening now isn't banks collapsing. It's banks flipping sides. The smart money that was short for decades just went long. And when entities with $4 trillion in assets decide they want physical silver, they get physical silver. Even if it means draining the Comex, especially if it means draining the Comex. The CME group, which operates the Comex, responded to the chaos by raising margin requirements. According to multiple sources, including Financial Content and Seeking Alpha, the CME issued Advisory 25-393, raising margin requirements for silver futures to $25,000 per contract. This forced mass liquidation of retail longs and temporarily suppressed prices in late December to early January to allow major banks to cover short positions before physical shortages hit. But as we've seen, that suppression was temporary. The physical market doesn't care what the CME sets margins at. Physical silver costs what someone with metal will accept to part with it. And right now, that number is substantially higher than paper prices. According to LBMA market analysis, cited by Bullion Trading LLC, lease rates for silver spiked dramatically in 2025. Bullion Vault reported that silver's 1-month lease rate reached more than 19% per annum, and subsequently spiked to 35% as silver prices touched all-time highs. For reference, normal silver lease rates are less than 1%. When rates spike to 35%, that's not normal market functioning, that's stressed market functioning. That's lenders saying, I'm not lending you my silver unless you pay me extortion rates because I don't think I'm getting it back. So where does this go from here? I can give you 3 scenarios based on how historical precedents and current market structure suggest this plays out. These aren't predictions, they're frameworks. Scenario 1, continued rally with managed delivery failures. The Comex and LBMA continue to experience delivery pressure but avoid a complete default by using cash settlements, force majeure declarations, and regulatory intervention. Silver trends toward $100 to $120 in 2026 with periodic pullbacks as exchanges engineer volatility to shake out weak hands. Physical premiums remain elevated at 10% to 30% over paper prices. Industrial users increasingly bypass exchanges and sign direct long-term contracts with miners. The 2-tier market becomes permanent, a paper market for speculators and a physical market for people who actually need the metal. This is the muddle through scenario. Scenario 2, acceleration toward Bank of America's upper target. China's export restrictions remain in place or expand. Additional countries declare silver a strategic material and restrict exports. Central banks begin openly accumulating silver alongside gold, which several reports suggest is already happening quietly. The gold to silver ratio compresses toward 30.1 or lower. Under these conditions, silver breaks $135 and trends toward $200 to $300 as the paper market capitulates and reprices to physical reality. This is the Comex paradigm shift scenario where silver transitions from being primarily an industrial commodity to being recognized as both a strategic material and a monetary metal. Scenario 3, regulatory reset and price spike. The Comex experiences an actual delivery default where a major commercial buyer demands physical delivery and the exchange cannot fulfill it. This triggers a force majeure event, cash settlements at prices substantially above market, and emergency regulatory intervention. Silver spikes violently to $150 to $200 in a matter of days or weeks before stabilizing. Governments fast-track strategic silver reserve programs. New rules get implemented, separating physical and paper markets explicitly. This is the crisis resolution through restructuring scenario. Which scenario plays out depends on variables we can't control. Political decisions in Beijing, in Washington, central bank policies, the pace of solar and EV adoption, and whether the Comex's remaining inventory can satisfy delivery demands. What we can control is understanding that the silver market of 2026 is fundamentally different than the silver market of 2020. This is not a speculative fever. This is a structural repricing. According to Financial Content's January 20th analysis, this moment represents a paradigm shift in how the market views precious metals. For decades, silver was treated as gold's volatile little brother. However, the 2026 crisis highlights silver's status as a critical strategic mineral. The comparison is made to petroleum as the geopolitical flashpoint of the 20th century, with silver and copper becoming the front lines of 21st century industrial policy. That's not hyperbole. That's recognizing that energy transition and technological advancement require physical materials, and those materials are finite. Trading Keys analysis concludes, in an age when paper silver's credit is in doubt, only physical silver can be trusted. Bullion Star states, the current dynamics in silver highlight precisely why ownership of real, deliverable metal matters more than ever. These aren't advertisements. These are observations from entities watching the mechanics break in real time. So here's the bottom line. On January 20th, 2026, silver hit $95.87 per ounce, shattering all previous records. But the price is just the symptom. The disease is a 40-year paper market that promised more silver than exists, discovering that the laws of physics still apply. You can create infinite paper contracts. You cannot create infinite physical metal. And when the gap between those two realities becomes visible, markets don't adjust smoothly. They break violently. The silver market just broke, and it's not getting fixed anytime soon. Because the underlying problem, industrial demand exceeding supply, compounded by export restrictions, compounded by decades of underinvestment in new mines, compounded by a paper market that was over-leveraged 356 to 1, that problem doesn't have a quick solution. You can't print silver. You can't mine it faster than geology allows. You can't change the fact that solar panels and EVs need it. What you can do is understand that the number on your screen might not represent reality, that physical and paper have decoupled, that 95 might be cheap if the trajectory toward 135 or 200 or $309 continues, or it might be expensive if this whole thing collapses back to $60. Nobody knows. But what we do know is that the system that is supposed to tell us the answer, the futures exchange the price discovery mechanism, the Comex, that system is currently making two different prices depending on whether you want a futures contract or an actual bar of metal. And when the price setting mechanism breaks, you're not investing anymore. You're guessing, which, come to think of it, is what we've always been doing. We just used to pretend the market knew the answer. It doesn't. Welcome to 2026. The paper market collapsed. Physical is king. And silver just reminded everyone that no matter how sophisticated your financial engineering gets, you still can't create metal out of ones and zeros.